In today's video, I'm listing off for you guys 3 dividend stocks with record high yields that I am actively buying right now. Let's get into it. What's up everyone, my name is Ale. Welcome back to my world of stocks. So like I said, these are dividend stocks that are currently paying record high yields because the broader stock market has been essentially crashing, and these stocks are not without their own issues too, but their prices are incredibly low. Some are at like decade lows, and I think the value is incredible at these prices. And if they continue to pay these dividends, I do not believe that these low prices are sustainable. So I think the prices have to go up. It wouldn't make sense for them to stay at these levels. So I think I can actually get some really big returns from not just the dividends, but also from the stock prices themselves. So I really like these stocks. I am buying them right now. In fact, one of them is actually a brand new purchase that I've never owned ever in my life. So it's going to be a fun one. I hope you guys enjoy this. But let's go ahead and jump into my list. Okay, starting here with the first dividend stock, that's actually going to be the telecommunications and internet giant Verizon, ticker symbol VZ. And no surprise here, I've talked a lot about Verizon. From its highs, this is a stock that has now crashed by over 40%, leaving it not only lower than the giant 2020 market crash, but it's literally trading at the lowest levels in over a decade. I mean, that's pretty crazy. And you know what this results in? An unbelievably high yield. I'm pretty sure that the only time their dividend yield was higher was during the Great Recession, which is somewhat of like a once in a lifetime type of event. But right now, Verizon's dividend is absolutely gigantic. It's at over a 7% yield. I never thought I'd see it this high. And what's even more crazy is that it's already been grown for almost 2 decades in a row. And despite the really high yield, it actually still has a pretty low payout ratio below 50%. So not only is management clearly committed to paying that dividend long term, but I would also say that it looks pretty safe here, because of only taking up like less than half of their free cash flow. I'd say they can definitely continue paying this. Speaking of which, for all of its faults, Verizon is really a cash generating machine, doing over or I should say around $40 billion of operating cash flow per year. Now, the issue is that more recently, Verizon has been investing super heavy into new infrastructure, including giant investments into 5G and fiber internet and increasing their footprint. We'll talk about some of that, but this has sent their capital expenditure skyrocketing last year to almost $70 billion, which is more than 3 times the amount that they spent the year prior. And that really sent their free cash flow crashing from over 20 billion positive in 2020 to almost 30 billion negative last year. But, some would argue that this was a necessary and, hopefully temporary setback in order to invest in their infrastructure and their business so that they don't lose too much ground to their biggest rivals like AT&T and T-Mobile, who are not only hot on their heels, but they also have been investing giant amounts themselves. But out of the big 3 here, Verizon to me still looks like the best overall option at today's prices. First of all, the wireless market, we know that it's completely dominated by the big 3. It's sort of a triopoly, those being, Verizon, AT&T, T-Mobile. But when you combine public, enterprise, and small business, Verizon actually leads the market at close to half of the entire market just on their own. And the reason why businesses choose Verizon over the competition is because Verizon is much more reliable. They consistently win the highest quality awards. They've done it for almost 30 times in a row, which is also the case among small business satisfaction. And it's even gained them the largest market share among first responders and public safety, where reliability is like the most important thing. And thanks to their huge investments recently, Verizon has also expanded greatly into prepaid with acquisitions of TracFone and Straight Talk, while also dominating the fiber internet market at almost 50% market share there as well. Now, in that market, fiber is superior in performance and quality, but T-Mobile only recently started using fiber themselves. Instead, they've been investing heavier into a wireless internet strategy because that tends to have more convenience and greater overall coverage. But even there, Verizon is also investing super heavy to disrupt that market too, with recent investments including their C-band wireless internet that is not only being supplied by satellites, which kind of helps them fend off some of the rising competition from like Elon Musk's Starlink, for example, but they're even using their own leadership in fiber to connect wireless towers with it and then provide wireless services to consumers through it. So their already massive infrastructure is only helping them expand their footprint even further in both phone and internet. Meanwhile, thanks to the stock crash, Verizon's valuation is dirt cheap right now with a P/E ratio that is about 50% cheaper than the sector. The drawback to Verizon is that they are very low growth, with sales typically climbing by only a couple percentage points per year. So the argument I always hear against them is that something like T-Mobile, for example, has much higher growth than Verizon, but T-Mobile also has a much higher valuation, like dramatically bigger, and they don't even pay a dividend either. So out of the big three, if I was going to invest in one of them, I would say Verizon is the best choice because of the performance, the reliability, the reputation, the valuation on the stock, and of course the mouth-watering dividends. Even just as a dividend stock alone, I think Verizon is a great choice. So I love owning it and I'm actively buying it. I happen to like this one. Okay, now moving on to stock number 2. That's going to be the newest dividend stock that I've purchased this year. And already, I gotta say guys, I've fallen in love with this one. And I just feel a huge urge to buy a lot more at these low prices. And that stock is of course Intel, ticker symbol INTC, which is the world leader in CPU market share, basically the main processing chip that computers run on. But more recently, this once dominant leader has made a lot of mistakes, and that really opened the door for rivals like AMD and Nvidia to steal a lot of market share, which is causing the stock price to get completely destroyed. From its highs, Intel is now down over 60%, and it's trading at right around the lowest levels over the past decade. On the bright side though, it's left their valuation insanely cheap. It's over 50% lower on a P ratio basis than the sector, while they've also raised their dividend yield. Because of the falling stock price, the yield has gone up to a record high that we have literally never seen before in their entire history. Right now, Intel's dividend is well above 5.5% of a yield, which is crazy to think about considering the super low payout ratio as well as the growth history. First of all, at a payout ratio of only 35%, that dividend, in my opinion, it's extremely safe. I mean, I'd be very shocked if they ever announce a cut to it. And when looking at the growth history, I know it only says 7 consecutive years there, but in reality, they actually started paying that dividend almost 2 decades ago, and they've literally grown that dividend every single year except for one of them. And even that year wasn't even a cut. They just paused the growth, but they still paid the same amount. So this is clearly a company that has a very large dedication to paying dividends, and they can definitely afford it. It just so happens though that Wall Street is too short-sighted and they're really focused on recent mistakes like delaying product releases that they don't see the long-term value in what Intel can offer here. Right now, the narrative is all around AMD and Nvidia stealing market share, while the overall macroeconomy is only making things even worse. And don't get me wrong, those are all valid reasons to push Intel down a bit, but the amount that they are overselling this stock at this point, I think is getting ridiculous, because out of the big three, I think Intel by far is easily the best choice in terms of value. Not only is the stock itself cheaper at a forward P ratio of only 10 versus Nvidia at 67, AMD at 29, they're much larger, but they also have a more dominant business overall with CPU market share of 82% for desktop, 78% for mobile, and 88% for server, while also commanding a lead in GPUs thanks to their integrated chips. Because of the dominance in CPUs, they pack on a GPU with it and they dominate that market too. It's kind of an interesting strategy. But they even released new discrete GPUs, so basically GPUs on their own, for the first time in decades, and they've already gained about 5% share of that market as well. So they're doing a lot of things. Now, this leadership has gained them a gigantic lead in profits with around $30 billion of operating cash flow last year, while Nvidia did less than 10 and AMD only did 4. These giant profits not only allow them to pay that huge dividend, which is probably the primary reason why I love this stock, but there's other reasons too. But anyway, helps them pay that dividend. But because that payout ratio is so low, which I showed you earlier for the dividend, Intel is also still able to invest really heavy on their business with research and development at about double the size of both Nvidia and AMD combined. That's pretty crazy. So right now, yeah, sales are expected to fall by 11% this year. That's a big drop. There's no sugarcoating that. It's definitely a serious concern. But the thing is that Intel is going through a transitional phase right now where product delays really set them back. And as an investor, you would kind of need to wait for their massive investments to pay off, which their new CEO thinks won't even happen until maybe a couple more years. But I gotta say, I believe him that things are going to get better from here over the long term. And one huge reason for that is because literally the entire country of the United States of America is depending on Intel being successful. America absolutely needs to make their own chips if they want any shot of competing against Asia on the global stage, who, by the way, currently produces around 75% of all the world's chips. That's coming from Asia. And Intel happens to be the only one of the big three here that we've talked about that not only builds their own chips, but they actually build them here in America, which is something that the other two contract out to Asia. They contract it out to mostly Taiwan. So America is now funding all of this money for building chips in America with the new CHIPS Act, and Intel is going to be one of the largest, if not the largest, beneficiary of that. In fact, they're now building the largest chip manufacturing plant in the entire world because of it. So you're telling me that I can buy a market leader of one of the world's most important markets out there for the long term, for the success of different countries. It's a hugely important market, and I can get a market leader of it for over a 50% discount to the rest of the sector, and on top of that I get a monster dividend. Yeah, I'm taking that all day. I know Intel has its issues, but I think they're heading in the right direction. I like what they're doing, and I'm looking to increase the size of my position in this one over time. It's actually like the smallest, newest dividend stock in my portfolio right now, but over time, I'm going to make this a larger, sizable portion of my portfolio because I really like Intel. I think there's a lot to like here. All right, guys, that's going to leave us now with the third dividend stock that I'm buying. And this is a stock that I have never owned in my entire life, but I am now finally pulling the trigger on this one because it has become such a great value in my opinion that it just cannot be ignored any longer. And that stock is Walgreens Boots Alliance, ticker symbol WBA. And if you're a frequent viewer of my videos, then you know that I recently featured it in my 3 stocks to buy video for the month as a risk. I included it as a risky stock that I've been researching more and I'm kind of paying closer attention to. But after doing further research on this one, I've come to the conclusion that yeah, at these levels, this stock is definitely a buy right now. First of all, from the top, Walgreens is currently down close to 70%, and it's now trading at the lowest levels in over a decade. It's also the stock on today's list that is down the most out of the ones we've talked about, and just like the others, Walgreens is now paying out a record dividend that is higher than any other point that I've ever seen in its history, and it's at about a 6.3% yield. And just like Intel, by the way, Walgreens also has a super low payout ratio of only 35%. I mean, I just can't believe that some of these dividends, guys, some of these stocks, they're trading this low. It's crazy. I mean, this dividend, in my opinion, is super safe. How is it trading this low? Plus, you might notice here that it only shows 5 years for the growth history, but that's actually completely wrong. I hate it when Seeking Alpha glitches like this, but Walgreens has not only paid a dividend for almost an entire century in a row, but they've also grown that dividend for almost 5 decades in a row. So it's almost a dividend king. I think right now their growth history sits at like 46 years in a row. So it just makes no sense to me. How is this record high dividend with an extremely safe and reliable dividend trading so low? The stock valuation right now is over 70% cheaper than the sector. I mean, that's crazy. Now, don't get me wrong, Walgreens wouldn't be trading this low if they didn't have significant issues. But like the other two stocks I showed you, they're just another example of what I think is extreme overreaction by investors. Because the biggest bear cases against Walgreens is that the coming retail apocalypse brought on by online shopping like Amazon is going to drive them out of business, and then they also have a lack of growth. Those are usually the two biggest arguments against them, so let me just counter both of those with my own right now. Starting with the latter, when looking at growth, Walgreens' revenue last year was about the same amount that they did in 2018, which was their record high. And ever since then, they've been struggling to break out of that low to mid $130 billion range. This year, sales are expected to be flat once again and only grow by about 1% next year too. But that's actually not that bad. I mean, I've seen many physical retailers go completely out of business. And with around 9,000 stores in the US alone and over 4,000 more stores internationally, you would think that Walgreens would be in heavy decline right now given their giant physical store footprint. But that's not really the case. I mean, in fact, earnings per share actually grew by an average of more than 13% over the past 5 years. And it's still expected to be about flat over the next 5. Now, granted, being flat is definitely not attractive to Wall Street. They always want huge growth. But it almost feels like investors are pricing this stock as if they're heading for bankruptcy or heading out of business, when that's clearly not the case. In fact, one of the biggest reasons why their profitability isn't expected to grow right now is because they're investing so much on future growth initiatives. The biggest of which is a recent $5 billion purchase of VillageMD stock in order to gain majority control of it so that they can now link up MD's primary care clinics with Walgreens pharmacy stores in order to increase synergies and attract customers to both businesses. And they're investing so much on this strategy that they're literally opening up a brand new clinic every 3 days. And you know why else this is huge? Because it not only provides much needed growth while increasing synergies and making them more profitable, but it also solves the other bearish issue, which is the retail apocalypse. First of all, clinics will never disappear because of online shopping. So attaching them to their retail physical stores makes their business that much more sticky and resilient. Plus, even with a more digital environment, Walgreens is doing everything they can to adapt to it. In fact, their highest growth segment is their new Walgreens Health segment that they've invested heavily into with new technologies to create an online healthcare platform that improves access, engagement, and convenience for all of the patient's needs. It also includes their care-centric subsidiary that focuses on healthcare from home. So even more virtualization there, and it also coordinates with pharmacies, which in this case will obviously be Walgreens. And with already 19 million members, you're talking about very large synergies here and a much more sticky business overall. As a result, the segment grew by a monstrous 65% last quarter. And don't forget, Walgreens also has an online store just like, Amazon would, which is also growing by large amounts. 25% growth last quarter, and that was on top of almost 100% growth the year prior to. Again, I just look at Walgreens and I see a stock here that is somewhat being priced like as if they're going out of business or at least heading in that direction. And I just do not agree with the mentality of the herd. And I think a lot of investors right now are just kind of going with the herd. They're just kind of going with the flow. Everyone's just kind of selling out of Walgreens and they're not really paying attention to the fact that Walgreens can actually survive here, and I think they can actually perform pretty well over time. And the valuation is so low that I just feel like they almost have nowhere to go but up. At least, give it some time here. I think Walgreens is definitely a risky play. You are betting against the herd, and we're living in a world that is becoming more virtual over time. But I think Walgreens is they're making the right moves. I think their business will get stickier over time, and I think they're going to survive this. And look, if Walgreens can pull this transitional phase off, you're talking about possibly like the lowest price that you might ever see in this stock and the highest dividend yield that you might ever get in this stock. So I think it's just worth the gamble. It's going to be the smallest dividend stock I own because I'm literally just now starting to buy it, but I think it's worth the bet. I do happen to like Walgreens. I would love to hear your guys' opinion on it below. Let me know what you think because it's my newest purchase. I'd love to hear your thoughts and we can have a conversation about it. But let me know what you think about every other dividend stock too. What dividend stocks do you guys like? Let me know, because I can make videos about those and I can also consider them for my portfolio. So I'd love your feedback. But anyway, thank you for stopping by. Hope you enjoyed the video. If you did, make sure you hit the like button, subscribe if you haven't already. It really helps the channel survive. But thank you again, and I will catch you in the next one. Hope you're all doing well. Take care. Bye-bye.